Hello there, I'm Jeff Spolstra with Summit Mortgage, and this is Mortgage Points. In this video, I'm going to talk about a topic that I get asked in various forms and various questions and whatnot, and basically boils down to, can the Federal Reserve control mortgage interest rates? And the answer is no and yes. So it's a bit complicated, like everything in the financial world is. But in this video, I'm going to talk about what the Federal Reserve can and cannot do. So the big thing that the Federal Reserve has control over is what's called the federal funds rate. This is the rate that financial institutions lend money to each other on a short term, usually overnight or daily kind of a basis. And you might think, well, why would Bank A want to lend Bank B money? Well, banks are required to hold a certain amount of what's called capital reserves. They have to have a certain amount of money in the bank to cover their savings accounts and et cetera, so that we don't have runs on the bank that drains all the funds like happened in the Great Depression. Those are called required capital reserves. And if a bank is particularly a little short on that, they might want to borrow some excess capital reserves from Bank A short term to cover that reserve requirement. And that's what the federal funds rate is. It's the rate that Bank A is allowed to charge Bank B for temporarily borrowing money from it. Now, this rate that's principally its use, but it does affect other things, right? It's going to also be the rate that a bank is probably going to charge its top number one key corporate accounts when they want to lend the money. And it does impact things like credit card interest rates, car loan interest rates, other short-term kind of personal loan rates. So, but it's not directly affecting interest rates. That's not one of the things that is directly tied to the federal funds rate. So when you hear people say, oh gosh, I wish the Federal Reserve would lower the mortgage rates. Well, the Federal Reserve can't do that. It's not in their power to do that. They can change the federal funds rate. Now, what does that do? Well, what they're trying to do is control the economy. When the economy is going gangbusters, that tends to drive inflation up. Well, how does the Federal Reserve slow that down when they think it's getting dangerously hot? Well, they raise the federal funds rate. That makes it more expensive for businesses and corporations and banks to borrow money. Well, if it's more expensive to borrow money, then you're probably going to be laying off people because it's expensive. You're probably buying less material and making less product because it's expensive to borrow for that. So it tends to throttle back the economy and lower inflation. Likewise, if the inflation or the economy is lolling around and just not producing, and inflation is too low, which is the thing, then the Federal Reserve is going to lower that rate to stimulate businesses wanting to do more and wanting to grow and produce more product. We saw this in spades during the pandemic when the federal funds rate was zero. The Federal Reserve was extremely worried about the economy collapsing during the pandemic, and they dropped that rate to zero to keep businesses moving forward. That's what the Federal Reserve rate really does to the economy. And that's how things get affected, or mortgage rates get affected as a result of the federal funds rate. And I'll talk about that in a follow-on video. But right now, this is Jeff Spolstra, and this has been Mortgage Points.